Hurricane Milton is already expected to cost at least $1 billion. I mean, let's be realistic, it's going to be much more than that. The economic impact are all over the place, no further than the southeast, parts of which were just devastated. The initial damage for homeowners is more than $47 billion. Economists are divided about the broader impact. Some claim jobless claims could go into the hundreds of thousands. Others say it will be relatively minimal. And even if they do have them, there's a bounce back factor. Randall Kroszner is with me, former US Fed governor. There is this argument, well, yes, they'll lose because of what happens immediately, but the rebuilding has its own economic sad impact. But overall, what will economists believe and the Fed believe about this?
So certainly this is tragic for the families and people who are losing their homes, losing their personal effects. When you put it into the bigger picture context, I think with seeing more frequent storms and very strong storms, it's a bigger risk premium that's coming in. And so there's going to be more risk in living in these areas. There's going to be more risk and difficulty in getting insurance. And that means it's going to be more costly to live in these areas.
But if you're governor of the Fed or you're the budget director in Florida, you have to make policies and economic models that now account for climate change.
For sure, and I think one of the things that you have to think about is that the cost of borrowing may go up in those areas. The cost of insurance, the cost of just operating anything in those areas will be more expensive. Instead of people moving away from these zones, people have been moving into these zones in the U.S.
And that's a difficulty, isn't it? The Sun Belt snowbirds,
yes,
if you will, that's moving down. And these states have done huge amounts on tax policy to attract people. No taxes in Florida, no income tax in Florida. Does that all look wise in hindsight?
Well, it's one of the challenges of, we have competition among the states in the U.S. Yeah. So some have high taxes, some have low taxes. And so, of course, the low tax states, no surprise, people are moving there. You've got a lot of retirees, the population is aging, so they're going to go where the taxes are low.
Let's talk on more general aspects about the Fed. Yesterday, we saw the 10-year take a bit of a blip,
yes,
which suggests, I mean, when they cut rates, we were expected 2 or 3 more before the end of the year. What's now the expectation, do you think?
So certainly much less than that, given that we are seeing a lot of economic resiliency in the labor market. The most recent jobs report was a real blowout report. I don't think anyone expected to be that much. I think it was higher than any of the economists had expected.
How can this be? How can it be only 4 weeks ago or whatever it was, you have things we need to cut by 0.5 point? Not just a quarter. We're going to go the whole 0.5 point. And now everyone's saying, oh, no, the numbers weren't quite what it's only a few weeks.
Well, there's always new data that comes out. Oh. We shouldn't also overreact to any one particular number. But I think people were worried that we were seeing a very substantial and rapid decline in the job market. That's clearly not the case. Certainly, this makes a stronger case for the so-called soft landing, or maybe no landing. I still think there are going to be some bumps going ahead because interest rates have gone up very significantly. And even as the Fed has kept interest rates constant before they cut, inflation was coming down. So the inflation-adjusted interest rate, the real interest rate, has been going up very substantially. And Milton Friedman always talked about long and variable effects of monetary policy. And so I think, by the end of this year, you're going to start to see some impact of that.
This slowdown that we saw, arguably, that led to the 0.5 point cut, largely was because we had underestimated the long tail of the very rapid rise in rates. How quickly do you think rates coming down, particularly, say, for example, in Europe, where the ECB has been more aggressive, how quickly do you think we will see that feed into the monetary chain and transmission?
I think just as it took a while for the actions of the central banks to bring inflation down, it's going to take a while for it to have the positive impact.
And so, let me just prove that you can't answer this question. And, it's a heads you win, tails I lose, or rather the way around, heads I win, tails you lose. In which case, you could find that preemptive cuts in rates will, in 8, 7, 9 months' time, stoke inflation.
It's certainly possible. I think, obviously the central banks are betting that that's not going to happen. And that's one of the reasons why the Fed was slow to cut rates. It was one of the last of the major central banks to do that because of what happened in the late 70s, early 80s. When they declared victory too early, they cut rates and then inflation bounced back up.
It is so good to see you, sir. And it is especially good to see you whilst we're here together in London. Thank you.
Excellent.